Yes, we are awaiting the May CPI, and 1% on the headline number, up 1%. That's definitely hotter than the 3/4 of 1% we were looking for. The high water mark there was up 1.2 in March, so we're close. And that 1.2 was a 17-year high going back to 2005. Strip out the all-important food and energy, it's still hotter than expectations, up 0.6%. It equals our look in last month, and to put a face on it, the high water mark here was all the way back in April of last year, up 0.9. That was a 4-decade high. But remember, both these are hotter than expected. Year over year, these are the Moneyball numbers. Year over year headline, 8.6. 8.6, a new cycle high, usurping March, which was 8.5. That was the highest since 1981. Now 8.6 continues to be the highest since 81 because the comp there is 8.9 to 11.8%. And if we look at year over year core, also hotter than expectations, up 6%, following 6.2%. High water mark there, 6.5, and that was in March, and that was the highest since 1982. But remember, even at 6%, it coming down from the high water mark of 6.5, that standalone is still the highest since 1982. So these are super stubborn numbers. And our panel, our esteemed panel, has lots of brain power there, and they go in lots of categories, Joe, as to why inflation's here, the all of the above mentioned. I will say that out of all the above, energy. And you know, there's so many comments here about, oh, the administration could only do so much. You know what? We all said that about the Fed. And then there's this thing called forward guidance. So the Fed gets the market to do things long before it takes action by telling them what's in their head, what lies down the road. What was the forward guidance with this administration on energy? We know the answer. Maybe they can't get things to happen faster, but by giving positive forward guidance, by not closing pipelines, by not talking pre-election about how much they don't like fossil fuel, maybe things would have turned out a bit different. Joe, back to you.
We're going to get right to our panel, but I don't think we've talked to Mike yet. I know I'm taking a risk going from Santelli to Santoli, even for me to get it right. But Mike, the reaction in the market has been swift, stock market.
You nailed it on the name. Yeah, it has. And now, look, as I said earlier, we were bracing for something that had the potential to be an unfriendly number, and we got it. Just for context, you know, the S&P 500, we were about 100% below yesterday's close, was the closing low. It seems like the market wants to test that range. I guess you'd have to say the peak inflation number, it remains plausible, the peak inflation notion, but maybe not persuasive. It's very difficult. And if you think back, May 2022 was when the math was supposed to start working in your favor on the annual number, because May 2021 was actually kind of a hot CPI. So that clearly is not the case. And it basically just means, you know, the Fed sees zero opening to lighten up on its rhetoric and on its plans for half-point increases in the next few months.
All right, our March read on the wholesale side of inflation in the form of producer price index, month-over-month change expected up 1.1, zoom, up 1.4%. This is a new all-time high for this series. The previous was, of course, of January 22, up at 1.2. Now, if we look at ex-food and energy, up 1%, it equals the all-time high, which was up 1% in January of 22. Now, if we strip out food, energy, and trade, expecting up 0.5, almost double that. Another hot one, up 0.9, but it avoided a new cycle high, which is 1% in January of 21. So missed it by a tenth. Now, on the year-over-year numbers, well, I don't see year-over-year headline number expected to be somewhere about 10.6. Just don't see it, folks. Now, if you strip out food and energy, I see that one. That's 9.2%. That's a new cycle high, usurping January of 22 when it was 8.5. And finally, ex-food, energy, and trade expected up 6.6. Well, it's up 7%, equaling the cycle high from December of 21. The only one I don't have, as I said, folks, is the year-over-year final demand, just a headline year-over-year number. So if anybody sees that, maybe they could pull it out. We do see we're hovering at 2 3/4 in a 10-year, up about 3 basis points. New Zealand getting aggressive. The ECB has their meeting tomorrow. We have a 4-day weekend in Europe, a 3-day weekend in the U.S., and stagflation is the water cooler buzzword that nobody really wants to use anymore. So I don't think I would be surprised, Joe, seeing some trimming on positions. Here we go. Finally, 11.2% is that first year-over-year number on PPI. And, of course, that's a new all-time high. The previous cycle high was, well, February of 22, up 10%. So pretty much only one metric missed in terms of cycle highs. They were all hotter than expected. And I'm sure this is going to be blamed for everything other than what it is. And that, of course, is that we have supply issues. But more than anything, some of our philosophical issues regarding trade have come back to haunt us and allowed nefarious activity to move on throughout the globe. Joe, back to you.
You're free to use nefarity. But you can say nefarious activity, but I coined nefarity, and then I found it had been used in the Washington Post, which, as you know, lights up the entire world with transparency. Steve Leisman joins us now.
Wait, they used that in the Washington Post? Didn't somebody ban the use of that word? No, maybe they allowed it to come back. Okay, I'm with you.
No, there's no darkness there. All light and goodness. Steve, even with the CPI, there were a couple of things that looked like they were moderating in recent weeks. Anything good at all here that wasn't hotter than expected?
Yeah, one thing. Let me get to that in just a second, Joe. This is the reason why I was a little bit unwilling yesterday to sort of declare peak inflation, is because there's still plenty of inflation up the pipeline here, and that's where the concern is. When I look at, for example, intermediate goods for processing, it's the stage before the headline number. Remember, Rick said it was 11% year over year. Well, check out intermediate, which is 21% plus. Now, that came down just a little bit from 23%, but there's still a ton of pressure up the pipeline. We have crude food prices up nearly 13%. There's still a ways to go, Joe, to work through, I think, what happened in Russia and Ukraine, on top of the previous high prices that we already had. And now you've had the lockdowns in China. We had reports earlier this week about troubles in citrus and all kinds of commodities and agricultural commodities that are out there. So I still think there's a way to go to work through what we've had here. It's why I'm not necessarily, ready to say peak inflation just yet. You've got to work this through. It goes from the producer down to the consumer in some measure. We don't know how much. Some of it could come from profit margins. Some of it could come in terms of pass along to the consumer. And who knows, maybe that used car number there, that 3.8% decline, was reaching a limit for how far consumers would go. But we're going to have to reach and find those limits in all sorts of categories before we get there.
Our April read on the consumer price index up 0.3. Strip out the all-important food and energy, up 0.1. These are each 0.1 lighter than expected, but headline is 1/10 heavier than or lighter than our last look as well. Expectations and rearview mirror were both up for 0.4. Now let's look at the year-over-year numbers. Both sets include 2%. If you look at headline CPI year over year, it's 2%. If you look at core year over year, it is 2.1. Now let's look at real average hourly earnings year over year for April, up 1.2. And if we look at weekly earnings year over year, up 0.9. The up 0.9 is a little disappointing. Our last look was revised from 1.3 to 1.4. So wages on the real side aren't accelerating. CPI is certainly not cold. It's not even cool. But it's not any hotter, and we could argue maybe it's a degree or two not as hot. Interest rates, almost exactly where they were yesterday towards the end of the day, but they are drifting a bit along with stocks. Joe, back to you.
All right, Rick, thanks. Stick around. Join us now, CNBC senior economics reporter Steve Leisman. Mike Santoli's back, Steve Grasso as well. So I thought, did you think that sounded kind of hot, Steve?
I had it wrong. Rick had it right. We sometimes don't use the same consensus, but we do this time.
It was
right.
actually cold.
It was colder than expected. I like the way Rick put it as well, Joe. It's not declining. It's just not too. It's not really moving. And the context here is important because you would think the way the economy's been running and the way unemployment's been running that there were expectations you would have higher inflation, but we're just not seeing it. Housing shelter up pretty good, 0.3, 0.4 right there. Decline in new and used vehicles down 0.4%. Sometimes that has to do with the time of the year. Airline fares down 0.1. I'm just seeing not a whole lot of inflation in there. Prescription drugs up 0.7%. That had been on the way down. It seems to be back on the way up the last couple months. Gasoline, though, up 5.7%. And that's going to kind of work its way through. I thought, guys, for a second, we
Not
talked.
going away.
What's that?
Not going away.
No, it's not going away, but it's not the acceleration. I think is not going to be in the next several months.
How did Powell have this misstep where he was enamored that there was lack of inflation before? When he first came into to sit in that seat, he was enamored by the fact that he couldn't find inflation. No one could find inflation. There was nothing around. And then when he sat in the seat, he said, well, we want to raise rates because we want to combat the slow and steady inflation. And now we see that backstep. And the truth is the Fed is going to look for reasons that there's zero inflation.